For me to really start to get bullish on gold, I do want to see we've got this first leg up, we got the pullback, as you just mentioned, David, and then we're probably going to see the second leg up. I want to start to see us break some of these highs, potentially all three of these highs, and then gold will have some type of consolidation, and more or less it will go from a series of a downtrend to a series of higher highs, higher lows. The moving averages will all start to layer in properly. We really do want to see the 50 and 20 day back above this green moving average. So
going down to 3,500 after this government announcement, where the government is now actively going to be going in to manipulate the yield curve by buying 30-year and so forth bonds and by issuing short-term debt. This changes the game. All right. Doesn't mean we can't go to 3,500. My high-end target was 3,900. That got tagged, and that's when the wedge broke out. 3,500 was my worst case bearish scenario for gold. My mid to long-term target is 13,000. That's 2029 to 2031.
Gold markets are experiencing a powerful surge as macroeconomic policies trigger renewed volatility across asset classes. While short-term traders welcome this massive price expansion, technical market confirmation remains vital before declaring an enduring precious metals supercycle. Chris Vermeulen, an acclaimed quantitative chart technician, and Gareth Soloway, an elite market strategist at Verified Investing, warned that emotional hype often masks underlying market fragility during critical transitional phases. They observe that despite gold tagging major breakout wedges, essential moving averages still need time to layer into a healthy structural alignment. Regarding long-term forecasts, mathematical cycle models project gold reaching a target of $13,000 between 2029 and 2031 as sovereign fiat systems face compounding stress. However, should current momentum fail near the $4,500 to $4,550 overhead barrier, a conservative downside test toward $3,500 remains a worst-case possibility. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
There's mixed signals in the precious metal space, right? And it really depends on the type of investor you are. Obviously, if you're a very short-term trader, you can see precious metals, gold, silver miners, they're in a very strong rally here. But when we step back, look at the bigger picture from the way that I invest in precious metals is I want to be invested in precious metals when they are in a new bull market phase, when they're having hopefully the next multi-year leg higher. And so right now it hasn't started that, in my opinion. We still have a series of lower highs. We have a series of lower lows. And while we've had a nice rally or bounce here, I mean, we have seen similar bounces in rallies of this size already take place many times, and they have eventually failed. So when we look at gold, this green 150-day moving average is kind of my long-term view or cycle on the market of, hey, it's trading flat or it's sloping down. Price is below it. That is usually the definition of we are in a correction phase for gold. And so gold is rallying up into resistance. It's had a very nice move this week, but it was based on news. And that always scares me when you have a strong bounce and everybody becomes very bullish and excited. We're seeing people pile into gold miners like it's going out of style. Everybody's jumping into the leverage plays around here thinking things have turned around, and maybe they have. But right now, to me, gold is if it has put in a bottom, it still has more work to do. So for example, for me to really start to get bullish on gold, I do want to see we've got this first leg up, we got the pullback, as you just mentioned, David, and then we're probably going to see the second leg up. I want to start to see us break some of these highs, potentially all three of these highs, and then gold will have some type of consolidation, and more or less it will go from a series of a downtrend to a series of higher highs, higher lows. The moving averages will all start to layer in properly. We really do want to see the 50 and 20 day back above this green moving average. So even though there's upside potential, it still takes a lot of time for the moving averages, for the momentum, for these major cycles to change corners. So right now we're still in the sidelines. We got out a gold a long time ago up near the peak, and same with silver. And so we are waiting for gold and silver and miners here to build this base, go higher, trade sideways, and then when the momentum fully shifts on the time frames that we look at, when they fully shift, we'll look to get long again. So it's exciting, but I'm not a believer in this rally just yet. I want to see higher pricing. I want to see more time. I don't want to see this fizzle out over the next 2 or 3 weeks and just go back down again. I think because what happens is you can get higher pricing. You can get really sharp higher pricing, like this huge parabolic spike. Everybody loves it, but it's not healthy, and it can unwind right away. But something that, if we go back in time, has more of a slow grind and moves higher. If it takes more time to go up, if it takes a nice staircase up, it's more sustainable. You want something climbing at like a 45-degree. You don't want it going parabolic. These huge last phases where things go straight up, you can't trust them because they can be wiped out in a couple of bars. So I do like higher pricing. That is the definition of an uptrend. We want the price to be rising, but it also has to hold it up for longer than a cycle. You look at these kind of cycles that are in the market, and we really want to see it hold up through kind of a time cycle, which the 20 and 50 day, I think, are very critical cycles to understand. Is it sloping up? Is price above them? And can it hold up there? It's nice to see precious metals starting to move higher and the miners coming to life, but the sentiment hasn't really shifted. I'm either in something or I'm not. So right now I'm on the sidelines, just watching the charts paint new candles each day. So the sentiment hasn't really changed, in my opinion, from my perspective. I know it's changed with the general public. I know everybody is all excited about precious metals. Miners, all of that stuff. A lot of people were saying 4,000 was the bottom for gold. They said this is it, and of course, everybody's super bullish on the precious metal space. So people have gone very, very bullish, which to me is actually a bit of a contrarian indicator. When we're in a long-term downtrend and everybody turns bullish and you get a strong pop and rally, I see it kind of as a relief rally, a bounce within a downtrend. So that's what we need to prove out. Is this a bounce that gets sold off into over the next couple of weeks and rolls over, or is it going to get legs and keep pushing higher and finally get that impulse move, that big move to the upside that's going to start to shift the trend, and there'll be enough time that starts to pass over another couple of weeks that will say, hey, this trend looks like it's actually turned a corner. So for me, I'm neutral. I know for the masses, everybody's excited about precious metals, and so the sentiment has shifted for the broad market for sure to bullish. If precious metals, if the trend turns around, is going down, we don't hold it. We always put our money into something that's going up in value. So that's the strategy. I don't believe in holding assets going down. It defeats the whole point of investing. So that's what the asset revesting book is about. After the rally, it's all about the 7 traditional kind of investment things that everybody does. It's pure education. There's nothing about the asset really investing strategy or my company in there. It's just teaching people about the pros and cons of all the different investing strategies that most people are doing. Everybody's probably doing at least 2 or 3 of them, even whether they know it or not, and what to be aware of. So it's kind of a book you read and you're like, wow, I never thought of it that way. You're gonna look at the markets, investing models through a whole new lens. You're never going to look at investing the same after you read this book, because you're going to see the side that, Main Street, the industry never wants to talk about, and how much of your time and life is at risk. And unfortunately, people don't really realize it until we have a financial correction and everything gets wiped out.
Recent Treasury interventions attempting to suppress long-term yields by issuing short-term debt have ignited aggressive liquidity shifts across global financial markets, when monetary authorities aggressively manipulate yield curves. Scarce tangible assets naturally attract defensive capital allocations. Parabolic ascents frequently exhaust themselves into rapid technical corrections. Without steady stair-step consolidation, massive news-driven spikes risk swift retracements. If the current rally encounters selling pressure, major support sits directly around the 4,175 pivot, which lines up with the critical 0.618 Fibonacci retracement zone. Extreme retail bullishness often serves as a classic contrarian red flag, signaling that institutional players may use extended resistance levels to distribute positions before momentum indicators properly reset. Now, let's get back to the interview.
We see gold having ripped higher. Absolutely humongous move over the last couple weeks. In fact, if we do a measurement just from this breakout of the wedge pattern, it was basically a 12% move. Incredible, right? Now, today we are getting a little bit of a pause day. That is not unusual, and I want to make that clear. Pause days are ways or means to refuel. So when you have a massive day like we had yesterday, where the government comes in and says, hey, we're going to up the amount of bonds we're buying back on the long end by issuing short-term debt. By the way, that's ludicrous, but that's what they're doing. They're trying to bring the long end of the yield curve down because it's gone up so much on the 30-year and the 10-year and the 20-year. But the point is that this is the recipe for higher metal prices in the mid to long term, as well as Bitcoin, if you're a believer in Bitcoin as a digital gold, as a scarce asset. 21 million supposedly, right? So that's where we are. Gold, again, has rallied up. It is at a little bit of resistance. Just looking at the chart here, you can see right here, this is the level. See these lows right through there? You can take that and you drag it right across, right through here. So you can see you hammered, bounced, hammered, broke down, and now you're back to this level. So this $4,500, $4,550 level on gold is near-term resistance. Now, listen. So far, all resistance have been blown through because of this powerful move in gold. So we have to assume that that could easily happen again. But at some point, we will get a decent pullback. And my guess is, believe it or not, it's coming sooner than most people think. Now, am I talking about going down to 3,500? After this government announcement where the government is now actively going to be going in to manipulate the yield curve by buying 30-year and so forth bonds and by issuing short-term debt, this changes the game. All right, doesn't mean we can't go to 3,500. My high-end target was 3,900. That got tagged, and that's when the wedge broke out. 3,500 was my worst case bearish scenario for gold. My mid to long-term target is 13,000. That's 2029 to 2031. You can see it in the calculator that I created where you can use it and calculate your own price target on gold. If you're a free member at Verified Investing, basically just have a free account at verifiedinvesting.com. But the point here is this, is that at this point, if the government, and I think this is going to happen, if the government is continually going to need to go back in and buy more long-dated bonds to keep the yields from going high, then it really just reinforces that they're losing control of the fiat system. And that, my friends, is a recipe, whether we pull back on gold at some point, which inevitably we will, it's a recipe to just keep buying gold on pullbacks. Same thing on silver, although silver has the industrial side, and to many extent, probably Bitcoin. I'm not convinced Bitcoin has made a bottom for the cycle yet, but it was due for a bear market rally. Now we'll have to see when risk assets start to sell more, does Bitcoin come in substantially? All right, so that's where we are on gold, guys. First major support on gold, if it pulls back, is right here around 41.75. Notice high pivot and high pivot. That would be a retrace. In addition, if we look at this, we can see that essentially that is a perfect 618 Fibonacci. How cool is that? The 618 Fibonacci literally marks that to a T, that trend line right there. And when you have a confluence of factors, remember, it increases the probability that that's going to be major support. Now, I did tell you, and I'm going to get to silver, but I did tell you I did do a trade today. I've started to inch into this here on the short side, and it is in the gold miners. Gold miners have run incredibly. They should be due for a short-term pullback before anyone freaks out, because I know we got a lot of nervous Nellies that probably, unfortunately, bet the farm on anything. This is a quick trade. I'm in and out probably within a day to 3 days on the miners. If it goes a little bit higher, I have room to add in dollar cost average. But I want to show you why I'm doing this trade, because remember, it has nothing to do with personal preference. It has everything to do with charts. Silver, this is optimistic. Silver trying to get above this resistance line, pivot trend line right here. Resistance, hit. Look at all these hits, and finally pushing above. Can it hold above this level? That is going to be key, my friends. If it can, then it's in the golden zone. And again, it can go higher. Now, it doesn't mean it's not going to stall out a little bit. But again, you had to get above this ascending trend line. It's trying to today. Let's see where it ends the day. We'll go from there.
Technical divergence continues to unfold across the precious metals complex as physical silver attempts a clean breakout above a multi-touch ascending trendline. Sustaining price action above this key hurdle confirms entry into an optimal accumulation zone, whereas leveraged mining equities show extreme overextension after vertical multi-week gains. Executing short-term tactical trades on overbought gold miners offers a high-probability asymmetric setup for active traders, targeting brief mean reversion pullbacks lasting 1 to 3 days. Sustainable portfolio growth requires waiting for the 20-day and 50-day moving averages to slope upward in tandem with underlying volume profiles. Holding assets that are actively declining in price defeats the entire fundamental purpose of long-term capital preservation and wealth building. Navigating these volatile swings requires strict adherence to price geometry, disciplined position sizing, and objective risk management rather than speculative sentiment. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.